In this week's video, we'll review the good, the bad, and the ugly to help us better assess probabilities walking forward. This portion of the video is being recorded Friday evening. This is a tweet on the left side of the screen from Friday morning, another tweet on the right side of the screen from Friday morning. It's incredibly important to understand what trade the chart in front of you means. Prudently assessing probabilities and preparing for multiple outcomes is radically different from making predictions, forecasts, or calls about an uncertain future. If you want to bring your ego into the equation, start forecasting. These videos are prepared for CCM clients. Our sole objective is to manage money well. Under our approach, we have already made decisions and we are already allocated with the data that we're going to cover in this week's video. Keeping a flexible, unbiased, and open mind about an uncertain future makes sure that we can handle all outcomes next week, not just the outcomes that we want to see or the outcomes that we forecasted or tried to predict. Tracking a wide range of breadth indicators can be particularly helpful after a waterfall decline and near a turn. You may remember in last week's video we covered the NYSE McClellan volume oscillator and said we had a setup that was similar to setups in 1974, 1982, 2009, and 2016. And as we demonstrated, in each case, good things happen for a long period of time, telling us to keep an open mind about better than expected outcomes walking forward. In the Friday, April 10th video, we also covered a constructive setup with advanced decline volume. And you may remember we noted that a look like this relative to a look like this can be helpful because ultimately charts are a reflection of human behavior. In this week's video, we'll expand on these concepts and see what we can learn. Forbes headline dated April 3rd, 2020. Unemployment rate shoots up to 4.4%. Chart on the right side of your screen, the top portion shows the unemployment rate, and this is a relatively rare move here. This is the 1-month rate of change in the U.S. unemployment rate. It reached a very, very rare level, 25.71%. Thus, it might be helpful to ask, has anything similar happened in the past, and what can we learn? Now we're looking at the same chart of the U.S. unemployment rate, but we're spanning the last 70 years. You can see with the rate of change, this is incredibly rare. We had a very, very similar spike with a similar magnitude back in the month of December 1953. The rate of change in the present day was roughly 26%. Roughly 29% in 1953. Since this is a very rare and similar look to this period here, it might be helpful to ask and answer. How did stocks perform after the 1-month spike in the unemployment rate in 1953, and more specifically in December of 1953? This is the S&P 500 here. If we walk forward, probably fair to say that the result was better than expected outcomes relative to how market participants felt at this point here. And maybe more importantly, immediately following that report, really good things happened in the stock market. Are we saying that March 2020 is identical to December 1953? No, we're not saying anything even remotely close to that. This is similar to this. And this tells us that it's possible that good things can happen for a long period of time in the stock market after something like this. The trend of incredibly rare or never seen before continues in 2020. Top portion of this chart is diversified bonds, think AGG in the ETF world, relative to stocks or SPY if we were using ETFs. Said another way, diversified basket of bonds versus the S&P 500. Incredibly rare move here in the rate of change in the ratio. Having the rate of change come down to this level here has only happened one other time in the last 30 years, and that was March 27th of 2009. If you're a student of economic and market history, you know that looking backwards from March 27th, 2009, this is a rough period back here, and very, very similar to the present day. The headlines in March of 2009 talk about recession, job cuts, comparisons to the Great Depression, a weak economy. This has occurred only 2 times in the past 30 years. How did stocks perform walking forward from March 27, 2009, which is similar to April 15th of 2020? The answer? Extraordinarily well. Very satisfying returns from March 27, 2009, all the way out to the year 2020. The S&P 500 tacked on an additional 315%. And that does not include the 22% V-like move off the bottom, telling us in the present day it may feel like it's too late or we've missed it. Many people felt the same way in March of 2009, and after this V move off the bottom, a rapid 22% gain, good things continued to happen for a long period of time. If you were managing money in 2009 or in the markets in 2009, you probably remember that very, very similar to the present day, a common theme in March of 2009 right in here was that the stock market had lost touch with reality. And with these headlines, that was easy to understand. Some similarities to the present day. Major decline in the rearview mirror, a 22% V-like move off the bottom, global recession, seeing comparisons to the Depression in this period here, talk of irrational markets, and we have a long list of never-seen-before Fed actions that occur in this period here. And yet, despite all of that, the market continued to surprise on the upside in the coming years. Before we move to the next chart, very, very similar concepts. Remember, this was similar to AGG versus SPY. In this case, instead of a diversified basket of bonds, we're looking at TLT relative to SPY or long-term treasury bonds relative to the S&P 500. Looking back to the year 2002, the rate of change for this ratio, the 17-session rate of change. It's been 17 sessions since the market put in the bottom on March 23rd. You can see the rate of change has only come down to this blue line 1, 2, a cluster here, 3 previous times. In the present day, it happened on April 16th, October 26th, March 26th, and November 1st of 2002. Therefore, it might be helpful to know, how did stocks perform walking forward from those dates? The answer is extremely well. 2002 case, S&P 500 from a long-term perspective, 73% gain. 2009 case, 300% gain, long-term perspective. 2011 case, 172%. And keep in mind, this date, and this date are tied to the present day via this extremely rare look. Our bottom happened 17 trading days ago when this chart was printed. Looking at the same 17-day rate of change, the present day looks like a major low in 2011, the period following a major low in 2009, and the period following a major low in 2002. Doesn't predict anything about the future, it simply speaks to the probability of good things happening relative to the probability of bad things happening. Covered some constructive breadth setups in last week's video. We covered another one earlier this week, April 14th post. You can find it by Googling this title here and our last name, Shavako. Very, very similar to the previous charts that we've covered. Something that just happened in the present day looks like periods where major lows occurred in the S&P 500. Since the model uses a weight of the evidence approach, it might be logical to ask, are we seeing similar and constructive setups on other indices? The answer is yes. We'll move quickly here. NASDAQ 100 bullish percent index. tells us the percentage of stocks in the NASDAQ 100 that are currently on a P&F buy signal, a bullish signal. We're not cherry picking the data here. We're using all the data that we have. We've only moved from the orange line back to the blue line 2 previous times. 2001 to 2003, 2008 to 2009. How did stocks perform walking forward? Extremely well. 6 weeks out, 3 months out, 6 months out, 1 year out, 2 years, 3 years, 4 years, and 5 years. In both cases, the stock market was higher. This type of look tells us from a probability perspective it's easier to be thinking longer term again, now that the waterfall decline has calmed down. In the first case, 4 years later, a gain of 55%. The second case, roughly 68%. And this is a form of a short-term breath thrust. There's really only one other period that looks like this, and that's near the major low in 2008 and 2009. Even in this case, it takes much longer. Since this is the NASDAQ 100, it might be helpful to know how did QQQ perform walking forward. In both cases, good things happened looking out 2 weeks all the way to 5 years. 5 years out in the 2003 case, 68% gain. 2009 case, 5 years out, 150% on the triple Qs. Those returns are walking forward from this date and this date, which is similar to what just transpired in 2020. Weight of the evidence approach. This chart's tied to the NASDAQ 100. This chart's tied to the NYSE composite. Very, very similar theme here. Rare to get a move from here to here. We just did it in the present day. This is something that we can see, measure, and put in a model. How did the S&P 500 perform in the only other case dating back to 1990? Extremely well, looking out 2 weeks to 5 years. First chart was a NASDAQ 100. This is NYSE. Anything else? Yes, similar situation, S&P 500, bullish percent index. We're looking at all of the data that we have back to 1996. A move like this, similar to what happened 2002, 2004, 2008 to 2009. What happened walking forward? In this case, it's a little bit of a reality check. Some volatility and givebacks looking out 2 weeks to 6 months, helping us maintain realistic expectations about how markets operate in the real world, walking forward even if good things happen. This table also helps us focus on our time frame. In our case, it's longer term. With the improvement that we've seen, if we can withstand some volatility, it's possible some very satisfying returns will come a few years down the road. Is there anything else? Yes, percent of NASDAQ stocks above their 200-day moving average. This move here occurred here, 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 and here. Those are the only instances dating back to 2002, using all of the data that we have. How did the S&P 500 perform walking forward from this point, this point, this point, this point, and this point? Once again, very, very satisfying returns from our probability perspective, 2 weeks to 5 years out. 1 year later, every single case the market was higher, the average gain was 24%. And in each case, the 24% average return is in addition to the initial move off of the low. This is NASDAQ stocks above their 200-day. Another extremely rare move, this time using the NYSE composite. If we go back to 2002, only 2 times have we seen something like this. This is the first case. This is the second case. This is an extremely oversold reading, an extremely rare oversold reading. The market starts to turn. The market starts to turn. At this point, we're just oversold. at this point we have some evidence of a turn. How did stocks perform walking forward from this point, which is similar to this point? Extremely well, looking out 2 weeks to 5 years. We've already covered the broader NASDAQ composite. Similar, rare, and constructive setup, something that we can see, measure, and put in a model relative to the NASDAQ 100. Percent of NASDAQ 100 stocks above their 200-day moving average. Present day looks similar to this area in here, this area in here, and this area in here. These are the only instances dating back to 2002, all of the data that we have. Once again, very, very constructive stock market performance looking out 6 months to 5 years. Using the weight of the evidence approach, similar situation with the S&P 100 index, percent above the 150-day moving average. In each case, market participants are very concerned about something down here. Market participants are very concerned about something down here, very concerned about something down here. How do we know that? This is an extremely rare oversold level, as is this, as is this. Concerned here, getting more confident here. Concerned here, getting more confident here. Concerned here, some evidence of confidence returning here. In these two cases, really good things happen looking out 6 months to 5 years. 2 weeks to 3 months helps us with the realistic expectations about how markets operate on a day-to-day basis. Volatility is part of the equation. A chart like this also helps us with the 2008 lower low case. Notice here, we've been focusing on data that's been similar to the present day in Q4 of 2008. The S&P 500 bullish percent index, this is the big rally in Q4. It gets back to this level here. We've done much, much better in the present day. The present day reading looks more like this reading here relative to this reading here. The data that we have in hand today, we have more of it that is discounting this another leg down scenario relative to what we had in hand just a few weeks ago. In this case, the improvement got all the way back to this level here, and then stocks tanked again. The fact that we look better in the present day simply helps us with probabilities, something significantly different relative to a certainty. Given everything that we knew a few weeks ago, how is it possible that this chart looks more like this constructive period in Q1 of 2009 and the fact that we blew right through this type of look from Q4 of 2008? A big part of the answer to that question is the Fed. They're doing things that they've never done before, something that we have to account for. The Fed is part of the market. Maximum flexibility also speaks to Fed policy. Thursday, April 16th, Fed's Williams says our work is not done. Fed Governor Williams made a very, very important point for all of us on Thursday, April 16th. Quote, to put the current situation in context, we are running more open market operations for greater sums than at any time in our history. This is the S&P 500. When it's falling in here, we don't know everything that the Fed is going to announce in the coming days and weeks. But maximum flexibility also applies to the Fed. So when the facts in front of us change, we have to reassess the probabilities, and the Fed is a big, big part of that process. You can pause your video player, or better yet, using this Twitter handle, you can find this table. The basic takeaway is this: data related to the virus can improve very, very quickly. Same Twitter handle here where my cursor is. Nice piece of research. 2003 case, 2009 case. Stocks bottom before jobless claims peak. And this is a broad concept that applies to all economic data and all news. Stocks typically bottom while the news and data are still horrible. Here's 2003, here's 2009. Here's 2003, here's 2009. Both of those periods are tied to the present day by the S&P 100% of stocks above the 150-day moving average relative to this type of rare move. Doubling back to trading the chart in front of you, let's assume a few weeks ago that we forecasted that the market was going to make lower lows, and we absolutely positively knew that any bounce would be followed by a retest. It would be very, very difficult, if not impossible, under that scenario to handle scenario 1 on the screen here. The concept in blue here, you can understand that a little bit better by Googling this title here with our last name and reading this post. The concepts in this post still apply heading into next week. Additional examples in terms of trading the chart in front of you can be found in this April 6th post on short takes. Before the market opened on April 6th, which was a Monday, we had already made decisions about the charts as of the close in the prior week. When the charts started to improve, we had to reassess the probability, and since that time, we've made several adjustments. We'll close the video with several charts that will help us prudently assess probabilities and properly prepare for next week, and that means preparing for multiple outcomes. It's hard to make an argument that this is not a constructive development on the weekly chart of the NASDAQ, April 17th, 2020. This video has covered several positive breadth developments. We still have concerning issues related to market breadth. This helps us keep an open mind about worse than expected outcomes. Dow, April 17th. Hesitant around the 50% retracement. Right now, it's hard to say that this doesn't look positive. The longer we stay above it, the better. If we reverse, we'll learn something as well. NASDAQ 100 has already taken out the 61.8% retracement. This chart and this chart, this data has already been reflected in the moves that we made this week. Since these markets are still hanging around the 50% retracements, still have to keep an open mind relative to the topic on the left side of the screen. We checked this chart all week. For the most part, there was a negative number here, and we were below this line. At the end of the week, this is also a potentially constructive development. The longer it stays above, the more bullish it is. If we reverse, we'll learn something as well that will help us make decisions next week. This is the chart that we have in front of us today. We've already made trades based on this chart. How it evolves next week, we don't know. What moves we make next week, we don't know. We'll head into next week with a flexible, unbiased, and open mind, prepared for all outcomes. 2 weeks in a row now, the S&P 500 is closed above the 200-week moving average. This is already reflected in our allocations relative to the moves that we've made in recent weeks. In terms of planning for a potential retest or retracement, the S&P 500 did close above the 50-day moving average, but we're still near it. This would be a logical place for a potential reversal, something that we're prepared for. The market was below these blue lines all week, closed above. We'll learn something here either way. This look here has already been reflected in the moves that we made over the past 5 trading sessions. We'll be watching the VIX next week. The 2009 case, basically when we dropped below and stayed below 38.56, good things happened in the stock market. We closed on Friday at 38.15. That is reflected in our allocation as of Friday's close. If the VIX moves in this direction, we'll learn something next week. If the VIX spikes back up here, in the 2008-2009 case, a move from where we are today, back to this level was followed by a 17% drop after we could see this in the S&P 500. We own stocks and we own gold. We'll learn something either way depending on how this plays out next week and in the subsequent weeks. This is something that we noticed during Friday's trading session, and it helped us make decisions on Friday. This is the 75 trading day rate of change for value stocks relative to growth stocks. This is going back to 2008. The rate of change being down in this level has happened only one other time, right near the major low in the S&P 500 in March of 2009. This happens, I believe, on the Friday before the Monday of the final low in the S&P 500. In any event, near the low after that, good things happened in the stock market. This concept here in this paragraph from this April 6th post also applies to Friday's session, April 17th. Once again, the market had a million opportunities to sell off on Friday. Didn't happen. Typically, there's information when something like that happens. It was helpful on April 6th. We'll see if it's helpful next week. Small caps, Friday, April 17th. This was also reflected in our decisions on Friday in terms of what we did and how much we did relative to moves on the stock side. This chart has work to do. It would be more constructive if this chart can make it into this area. It has not done so yet. You can pause your video player. There's a lot of good information in this tweet. Pause your video player here as well. The look of this chart here aligns with all of the breadth data that we covered in the meat of the video this week that tells us to keep an open mind about better than expected outcomes. April 17th, all-time high relative to positions in equity futures. Here's a high here, comes near a major low in the S&P 500 in black. These two spikes here come near bottoms, a major low, 15 and 16, good things happen. Spike here near a major low, good things happen. Bigger spike here. This sends a very, very similar message to this chart here, telling us it's possible now, relative to the probabilities, to try to think a little bit longer term, which is exactly what's happening when market participants are buying equity index futures here. They're thinking longer term, good things happen here, 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 and here. It remains to be seen whether they're right here. Pretty good decision here. Pretty good decisions in here, good decisions in here. We'll see how this one plays out. We'll learn something either way. This post contains something to help us keep an open mind about better than expected outcomes. It also enumerates numerous things that are still concerning. And the numerous things that are still concerning help us prepare for all outcomes, including a reversal or even a retest of this low. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.